Hello everyone and welcome back to the channel Finance with Ian. My name is Ian and today we are asking the question, are stocks better than ETFs? As you guys may know, the stocks have been trending down the past couple of days. However, the most worrisome part is that YouTube likes are also trending down. So let's do our part and tap the like button to push this video to a larger audience, subscribe to stay tuned for more financial videos in the future, and let's get into this. Stocks or ETFs? A lot of investors have come across this question when they first got into investing, just like me. Which one's more profitable? Which one's more likely to grow faster? Which one's going to be the one to pay dividends? There's a lot of questions out there like that, and I hope to give you my 2 cents on this video. Hopefully you guys will be able to learn something from this. But to explain everything properly, we're going to have to know what stocks and ETFs are. When someone talks about investing or tells you to invest, the first thing that probably comes to your mind is stocks. But what exactly is a stock? A single share of a stock represents fractional ownership of the entire company in comparison to all the other stocks. This typically entitles the shareholder to a portion of the company's earnings and other proceeds from liquidation. Then all earnings and proceeds are divided among all the shareholders depending on how much stock they own in proportion to the company. Stocks can be bought or sold privately or on the stock exchange. All these transactions are heavily regulated by the government in order to protect the investor, protect the company, and benefit the economy. Basically, buying stock means you get to invest in a company and also reap the rewards if there are any. Now that we know what a stock is, we need to discuss what an ETF is. An ETF stands for Exchange Traded Funds, and it's usually a security that's actually a collection of securities, such as stocks. It often tracks an underlying index, and it can invest in many different areas and use different strategies. ETFs, just like stocks, are also listed on exchanges and can be traded throughout the day like any other stock. The simple advantage of owning an ETF over a stock is that you now have a collection of stocks. Picture this scenario. You're a brand new trader and you think that the technology sector is going to boom over the next 10 years. So you go out, you do your research, and you buy a couple stocks in a few companies. I should be specific, technology companies. But after a few months, those technology companies were found to be either doing something wrong, the business model didn't work, or they were just hiding fraud, and the stock collapses. Now you're holding on to a ton of shares that are nearly worthless, and if you sell it, it'll be for a big loss. Now in a second scenario, you're also a new investor and you want to invest in the technology sector. But instead of investing like in the first scenario, where you buy individual stocks, this time you buy an ETF that has a collection of technology companies. Remember, an ETF is like a basket of companies where you have a few fractional shares in each company. Now say 1 or 2 companies in that ETF goes bankrupt, and those stocks plummet down. Well, because you have multiple other companies in the ETF, they can actually offset your losses, so you won't take as much of a hit. Now that we know what they both are, it's time to do our research and see which one's better to invest in. Let's do a little homework on stocks first. Let's go back and say you invested $1,000 in Apple in 2002. Would your investment be profitable? Needless to say, Apple is one of the biggest companies out there, and yes, it would be very much profitable. In fact, an investment of $1,000 in Apple back in 2002, a little over 18 years ago, would now be worth $360,000. That's an insane amount of growth for a stock, and it may give us the idea that stocks are the certain one to invest in, right? But hold on a second. What if instead of investing in Apple, you invested in a company like Hertz, or something like Sears back in the day? As you know, both of those companies' shares have gone down dramatically, and Hertz is in fact bankrupt. So there's a chance of getting lucky and picking a really good stock, but there's also a chance of picking a bad stock and losing your entire investment. Not to mention the majority of stocks underperform ETFs and indexes. Now let's research ETFs. The most commonly traded ETF in the United States is the S&P 500. SPY or SPY is basically the same thing as the S&P 500. It's just buying shares that are 10% of the S&P 500's actual shares. This is great for the newer investors so they don't have to fork up $4,000 of cash to buy a share of S&P 500. Instead, they can get into the same ETF by buying SPY for around $400. And the reason why SPY or the S&P 500 is so popular is because it tracks the top 500 companies in the US. These revolve every year. Some are dropped, some are put in, but basically you're buying into the top 500 companies in the US, so your returns are usually good. So back on the topic between stocks and ETFs, the difference between the two are just diversification, right? Well, yes, but there's another big factor in here, and that's the return rates. When you own an ETF as big as the S&P 500, which holds multiple companies, your risk of losing money is low. But because there's such a diversification in that ETF, it also has low return rates. The S&P 500 has a national return rate of 11% each year. But when you account for inflation, which is about 3% each year, it goes down about 8%. It's not incredible, but at the same time, it's not like a bank interest rate. My savings account interest rate used to be 0.01%. So if you consistently invest over your working life until retirement, you should be able to live off the interest that your ETFs generate. And then when it comes to stocks, it can really be a big boom or bust. You could be really lucky and find that Apple stock in 2002. Or you can be the guy who invests in a bad company and then ends up losing it all. Because there are so many stocks out there, it's really hard to put an exact number what the return rate of a regular company stock is. When we're thinking about a fixed rate of return over a long period of time, ETFs win, and I'll tell you why. So let's say you do want to invest, and you invest in the S&P 500 until retirement. You put $1,000 into it when you turn 18, when you finally get to open that brokerage account. From then on, you contribute $200 each month for the next 50 years, until retirement. If you were to continue that and retire at the age of 68, which is just a few years after the national average of 65, your total investment would be worth $1,473,720 and 21 cents. Since by this time, this money would generate around 7-8% each year, you could take out 4% each year and live off of it, which by the way would be $55,000 each year. So let's say in another scenario, you invest in individual stocks to get to retirement. So let's say you did get lucky and you invested in Apple back in 2002. Over the course of 19 years until today, your investment would be worth $360,000. That's an insane amount of growth, and that's a return rate of 36% each year, or over your total investment, 36,000%. So it seems like a great choice to invest in stocks, but you have to remember it's hard to find the perfect stock to invest in each time. Just like I said earlier, you could invest all that money into something like Hertz and then lose it all. So we've looked at previous examples of ETFs and previous examples of stocks. And now it's time to come to our conclusion. So which one's better to invest in, stocks or ETFs? Well, the answer is we don't know for sure. There's too much speculation involved, too many factors, and too many what ifs. Although I'm happy to share my 2 cents when it comes to investing. So I have a brokerage account and Roth IRA, both with TD Ameritrade. In my Roth, I hold ETFs that I'll probably hold until retirement. The S&P 500 is a really good one. And in my brokerage account, I buy and trade individual stocks, which I'll probably hold between 5 to 10 years. And here's where you'll find technology stocks, medical stocks, and a few blue chip companies. Maybe a penny stock every once in a while. So when I invest like this, I can conservatively invest in my Roth IRA, until I retire that is, but I can also reap the benefits of dividends and growth stocks in my main brokerage account. In the end, it really comes down to what you want to do, whether if you want to play a little more risky with stocks or invest conservatively with ETFs. The individual stocks may be the ones that get you some growth, but your ETFs are probably going to be the ones that carry you to retirement. However, this video is for entertainment purposes only, and make sure you do your research before you just trust some random guy on the internet. So go do your homework before you invest. But before you go, I do need you to invest in one thing, and that's tapping the like button so it turns blue to push this video to a larger audience. Thanks for watching the video, subscribe to stay tuned for more financial videos in the future, and I'll see you guys later. Thanks for watching.